This one makes people really uncomfortable a lot of times, but let's say you report $140K in taxable income. Then you go ahead and buy a $1.8 million home, purchase 2 new luxury vehicles, write them off, deposit a large chunk of unexplained cash deposits, and you show significant brokerage contributions. Here's where the collapse I see happens. Spicy takes and tax breaks. I'm Aubree Denekamp, also known as the Write-Off Queen. I'm here today to talk to you guys about something that might piss a little people off, so get ready to loosen your shoulders for a second. But most of you have been, or most of us have been, scared of the wrong things. And I don't really mean that dramatically. I don't mean that someone has been lying to you intentionally, but somewhere along the way, a lot of us have gotten trained to panic over a lot of the little small stuff, especially when that comes to taxes. But I sit in an office all day with clients, and a lot of these are really successful, intelligent, amazing business owners. And a lot of them whisper things like, can I really write off meals? Is this too aggressive to take this trip as a business trip? Can I deduct mileage? Should I just claim one child? Is this okay? Should I claim a home office or not? I do work from home, but I also live here. Is it suspicious to deduct this? XYZ. Meanwhile, they're completely ignoring that the patterns that actually are the biggest part, they are what cause enforcement attention. They are obsessing over things like $1,200 in meals or $4,800 in travel or mileage, and really their bookkeeping is chaotic. Their deductions are potentially correct, but a lot of the actual distributions are fully incorrect. Margins swing wildly year from year, and owner compensation sometimes is fully wrong. Financial behavior is what needs to be consistent year after year. So instead of continuing to answer these questions for my clients, I flipped the question. Instead of asking, what are the audit triggers? I started asking, what is the IRS enforcement system designed to do? What does it actually care about? So not emotionally, not politically, logically, what does it care about? From there, I went ahead and I built 5 real world scenarios based on actual client patterns that I've seen. These are with same income levels, same deduction totals, but completely different behaviors. And what ends up mattering the most is it's not the size of the deduction most of the time. It's the pattern. And once you understand this, you stop operating in this scared bubble and you can start operating strategically and planning these deductions strategically. So what does the IRS actually care about, and what is the system built to do? Let's reset something foundational. The IRS is not emotional. They really don't care about you versus John Doe next door. So it does not wake up thinking, do they have their Starbucks receipt handy? Or do they actually take a trip that was personal? It's a data enforcement agency. Its job is to protect revenue, detect systematic underreporting, identify statistical outliers, enforce compliance through consistency. So it's running comparison models. It matches 1099s, K1s, W-2s automatically. It compares your industry margins to others in your revenue bracket. So it's comparing this year after year after year. It compares to reported income known, third-party data, and whatever else is there. It doesn't feel like deductions are aggressive as a nature. It measures anomalies. So say that again in your head. The IRS does not care about that $1,400 write-off you might have taken, but it does care about your behavior pattern. Now, let's walk through this with some real scenarios that I've actually seen collapse. So scenario 1 is big deductions versus inconsistent reporting. So let's say client A, they have $600K revenue, $150K in expenses, stable 3-year margin, clean books, documented receipts, payroll is consistent. Client B also has $600K revenue, only $90K in expenses this year, but they did have $220K in expenses last year. There's no reconciliation, random owner transfers, margin swings from 35% to 12% to the following year 41%. Guess which one the IRS considers riskier and typically goes to that next level of review? Most people will say, well, obviously the one with the bigger expenses, they had less net profit, blah, blah, blah. Wrong. It's the inconsistent one every single time. I had a client actually come to me after a prior CPA relationship had imploded kind of horribly. Revenue was steady around $500,000 for about 3 years, but expenses were all over the map. 1 year showed over $300K in expenses. The next year was at $90K expenses. Following year, 290K. When I asked why, they said, I don't know. That's just what my CPA had filed. There was no trail for us to follow. So what we did is we had to go back through all of the statements. We went back through their QuickBooks file. And what happened was a lot of the deductions were actually claimed personally instead of continuing through the business, which was incorrect and they got no credit for. There was no structural explanation for this. That volatility without any explanation is what reviews that model. And it goes into the next stage of review. Unfortunately for this client, they did end up audited, is how they ended up working with us. But it wasn't the fact that they wrote meals. It was that unpredictable behavior, and that does trigger review. It's based on that system. It's not optimized deductions in any case, or if it is, then you fight that audit and you win. Let's go through scenario 2. This is going to be the lifestyle mismatch. This one makes people really uncomfortable a lot of times, but let's say you report 140K in taxable income. Then you go ahead and buy a $1.8 million home, purchase 2 new luxury vehicles, write them off, deposit a large chunk of unexplained cash deposits, and you show significant brokerage contributions. I had a client once very similar to this, and it was a W-2 earner. They reported income around 160K in this scenario, but they were moving money like someone who earned upward of 600K per year. And when we dug in, they had side income that they didn't think necessarily counted or need to be applied to their tax return, but those K1s definitely did and were also being reported on the flip side to the IRS. So that crypto transaction that maybe you forgot about, it does matter. Those cash deposits from consulting work that never actually hit a 1099 because the employer wasn't processing, that is what the enforcement system cares about and is looking for. The signal misalignment there. So if your income says one story, but your financial behavior is telling a different story than that, that's more interesting than your 8K in travel deductions and whatever you had in marketing. It's not about a punishment, it's about pattern and inconsistencies with those patterns. Let's jump into scenario 3 here. And this is one of the ones I see most often, and this is the sloppy LLC. This one, it hurts a lot of people's feelings, but it's so easily avoidable. If you are a single member LLC, let's say you have no payroll, owner takes random transfers as like draw, transfer, ATM, miscellaneous, whatever that is. The books are unreconciled at least 2-3 years back, and there's really no separation between those business and personal expenses. And that is not illegal. And this is where I get a lot of pushback from clients. But it does scream to the IRS and these monitoring systems that this business is not operating legally or intentionally at best. And here's where the collapse I see happens. The owner makes, let's say, $300,000 in revenue, but they can't tell myself or the IRS what their actual net margin is, what they took in deductions. They can give me rough amounts at best. If there is any payroll compliance that they should have, what that is, and what documentation supports these major deductions, specifically assets that you're claiming. So when your books look careless, your return absolutely ends up being careless. And careless returns are much easier to challenge and a lot harder to win. So if this is where the audits don't even have to be aggressive, they just start asking questions that you can't answer quickly, the bigger that ends up imploding. So scenario 4 here is going to be credits without structure. Credits are different than deductions. Credits directly reduce your tax liability. They're much more powerful because they're higher scrutiny, because they're more powerful. So I've seen this with, like, let's call it an employee retention credit, energy credits, R&D credits, fuel credits. Clients always come to say to me, well, my CPA told me I qualified for this. Okay, well, show me how. What is that research and development for? What is that $1 million deduction you're taking? I need to see the calculation, the qualification document, methodology behind it, some sort of legal basis. A lot of times I'm met with complete dead silence, which is terrifying because the IRS will require it. I'm just more inquiring to protect you. But credits require architectural support, not at all a guess, not optimism, definitely not TikTok or even Google advice at best. It really does require structure. And if you can claim credits correctly with documentation, you are perfectly fine and should absolutely be taking advantage of them. And if you claim them casually, this is where the scrutiny really starts to creep up and enforcement attention definitely increases. So I would recommend avoiding that at all costs. Scenario 5, let's go through the margin collapse. Let's call it you're up 72% for revenue, profits down about 80%, but your expenses are ballooning. I've seen this exact situation, and it doesn't seem like those are huge numbers, but business scales fast. Owners upgrade their lifestyles quickly, hire aggressively often, they start writing off everything, and they don't track margin impact. On paper, though, it looks like revenue exploded, profit vanished, and if there's a clean explanation for that, marketing expansion, inventory build, capital investments, fine. If there's that, then the pattern is not an anomaly. But if there isn't any of that, it is. So again, it's not illegal, but it's definitely interesting to the IRS. And enforcement systems are built to find interesting. All right, so I've given you kind of the negatives here, but what this means for you is stop obsessing over writing off lunch, writing off your Wi-Fi, your home deductions, subscriptions, any of those things. I want you to be writing all of this off legitimately. Start obsessing, though, over clean books, monthly reconciliations, some sort of strategy planning, and consistent margin logic. Like, this is incredible for you, especially if you do want to ramp up some of your deductions. Documentation matters here. Be obsessed about that. If you want to create a reasonable compensation, if you're required, do it already. But if you want to start learning that, make sure you have that structural clarity. Optimization is legal. Chaos is suspicious at best. So I have clients who deduct aggressively because they absolutely can. I encourage it. They qualify, they keep it documented, the structure absolutely supports it, and they sleep at night. So do I. I know I'm not going to get into an audit. I also see business owners deduct conservatively, but operate absolutely chaotically, and they're terrified a lot of times, and sometimes these do prompt audits. Fear doesn't protect you here. Structure absolutely does. So you don't need to operate scared. You need to operate structured. Fear makes you small, structure makes you powerful. And if you've been white knuckling every deduction, stop. If you've been avoiding legitimate tax strategy, stop. If you've been shrieking because your business decisions out of audit fear, stop. You're focused on the wrong battlefield here. The real game, the credibility, that is it. Documenting and making sure you have that structure in place. And credibility is built through consistency. The IRS doesn't care if you optimize. It cares if you can explain and document. And when you can explain that with your clean books, documentation, receipts, intentional structuring, you stop playing on a defense and you start playing on an offense. Make sure that you guys are doing that, and send this episode to an entrepreneur who thinks mileage logs are potentially their biggest threat to their business or audit situation, because it's not. And next episode, we're getting into it way deeper than we have before. I'm going to tell you what happened when I interviewed 100 entrepreneurs, and they admitted when I asked them one uncomfortable money question. And this one hits deeper than taxes ever will, and it was great to hear. A little bit surprising, so I'm interested to share. Looking forward to talking to you next time. Make sure to hit subscribe and follow along.